Welcome everyone to another webinar featuring, he needs no introduction really, but his name is Charles Savage. He is our group CEO. And we also feature Henno Nel, who is one of our easy investors. He's like the dopest person I know among our investor community. So we invited him here to be the voice of the community. So he will be moderating all the questions that come from you guys via the Q&A section. But without further ado, Charles, welcome.
How's it, man? Good to be back on. Looking forward to engaging with all of you.
Purple Group, we had the AGM on the 22nd of Jan. We had a lot of engagement from our community. It was actually very dope. But now I think our community wants to hear more from us, and particularly you as the boss man. So I'd just like to jump into it. We're going to touch on a lot of things, you know, from the Capitec deal to what's happening in the markets and Robinhood and how it affects us, to easy equities and retail investors. But for now, I just want to understand what's the overall priority of Purple Group?
Yeah, I mean, that's a tough question because we're actually in the throes of sort of setting those priorities. But let me tell you what the landscape sort of looks like right now. So, you know, when we think about easy equities, the priority really is about scale, stability, and security. And you know, last year we had quite a lot of fun building new stuff. We launched new projects like Easy Properties, or new platforms like Easy Properties. We launched a new region in Australia, and then we blew the market away with Almira's UX on our app that won the MTN award. So we had a lot of fun last year. But at the same time, one of the things that happened is the business scaled radically over the last 12 months in terms of the number of customers it needed to service, the transaction volumes that come with that, the deposit volumes, the withdrawal volumes, just everything. So, you know, the real focus this year, 80% of what we do, I think, is going to be consumed by scaling, stabilizing, and securing the platform even more. It's not to say that it's not secure, it's not to say that it's not scaled, but the demand for easy equities just keeps growing and the rate is not letting up. So I think that's where 80% of our time will be spent. And I say what I really mean by that is the majority of the resources in the group will spend their time there. For my time, because I'm not good at any of that stuff. I'm not a scaling, security, stable kind of guy. So for my time, I intend spending my time around international growth and growing our international business. So we already have two currencies offshore, which is obviously the USD platform and the Australian platform. And South Africans are coming to use those more and more. But we want to scale that opportunity into more markets. So we want to add GBP, sterling, and euro markets in the next year. At the same time, we want to launch our first office in Africa, and we want to start with East Africa. I mean, we're already operational in Namibia, but that's like kissing your cousin. So we won't count that as another African country just yet. But we certainly want to launch into East Africa, which we're excited about. It's a region that's very familiar with fintech payments. Money moves very easily. There's no exchange control, so very easy for them to not only move money within their borders, but offshore as well. And we think that they'd be very interested in our platform capability. And then obviously the Australian business is a real on-the-ground business where we've got a one-man team there. Brad Kaplan's looking after that business, and it's never a cool experience to try and build a business on your own. So if it wasn't for COVID, we would have sent more people there. I would have spent more time there last year. I'm hoping that COVID clears enough that I can spend some time helping him build that business in the year ahead. But if it doesn't, if COVID doesn't give us the opportunity, then we're going to spend a lot of time on Zoom and doing this kind of stuff just to assist him and see if we can get that business to grow faster. So really excited about what we could produce in Australia. That's it for easy equities, but for the rest of the group, Easy Properties, I think, has got an amazing year ahead of it. I mean, it had a great start to the year. First 6 months sold 60 million rand in property, 15,000 active customers. I know, Standwa, this is a brand you've fallen in love with, and I think we were just playing games in launching it, understanding what our customers like, how the platform works, what improvements we can make. And I think we're sharpening our focus now. And, I think the rollout of new properties is imminent. And I've seen the pipeline of properties that are going to go on. And I would think we'll probably end up our financial year, which is August, having sold about 200 million rands worth of properties. So I see that, more than doubling from the first 6 months. And I think the user base will do something similar. I think we'll go from somewhere around 15,000 users to somewhere around 30 to 40,000 active users. So that's a really exciting opportunity. And, when you think about that business and then you compare it to Easy Equities, when we started Easy Equities at the end of its first year, it had 10,000 customers, and I've forgotten what the assets on the platform were, but they were a lot less than 200 million. So, super excited about seeing the year out, Easy Properties having somewhere near 35,000 customers and 200 million in assets. And that's really the focus for Easy Properties. We've got one piece of functionality to add, and that is the ability to buy and sell into these properties, sell your shares and buy new shares, and that's an auction component. We're going to run that in beta now in this quarter, and hopefully it passes the beta, and then we can take it live probably towards the end of this quarter. And that'll provide liquidity for those who want to exit. And big caveat there, we didn't sell these properties for short-term gains. It's a long-term play. But we also realize that unexpected stuff happens in people's lives, and when that happens, they need liquidity. So that auction component really is there to provide liquidity to people who need liquidity, not to provide a speculative platform for people who want to trade in and out of properties, because you're not going to make money that way. It's not how it works. It's long-term. You want to get your dividends out of the interest yield that you get, rental yield that you get from owning these properties, and then hold them over the long term. And I really am confident that our residential property market is going to start to grow. The signs are already there. I saw an article a couple of weeks ago to say that South African property is back off to the races and seeing lots of growth. And interestingly, my wife works in the industry and she's super busy selling property again, which she wasn't for the last 12 months. So I think residential property is going to pick up again. So this is going to be a good long-term hold for investors. So those, don't use the auction opportunity to get out unless you really need to. And that's all that Easy Properties really needs to do for now. In fact, it shouldn't do anything else. Focus on new listings, growing its customer base, and delivering the liquidity through the auctions. Then, we've got a couple of other assets in the group that are also starting to shine. Emperor really deserves some special mention, because one thing that's changed since the AGM is that we had the Raging Bull Awards this week. And for those who don't know, the Raging Bull Awards it's the Academy Awards for asset managers in the country. And we won, and I've got to get this straight. Someone can correct me if I get it wrong, but I think we won best straight line performance over 3 years with our Emperor IP Global Momentum Fund, which did compounded annual growth over that 3-year period of just over 43% per year. That's unbelievable. That's incredible. Great track record, and kudos to Sean and Sinclair who run that strategy. There are over 1,500 managers that compete to win that, and Little Emperor's just won it. So that's super exciting. And I think on the back of that, Academy Awards, a bit like Academy Awards, where if you win an Academy Awards, you can be sure that you're going to get more movie deals. I think you can be sure Emperor's going to get more movie deals too in the year ahead. So looking forward to the year that Emperor's going to have and the assets that it's going to acquire, both through Easy Equities and also through institutional interest. And then GD247, probably the unloved asset in the group if you look at how much focus and attention we placed elsewhere in the last few years. And it's gone about its business in a methodical way, and it's lowered its cost base while keeping all of its revenue, and has delivered really strong returns to the group over the last 3 years. It really has been the cash cow on which all of our dreams have been built. But we've got to pay it more attention this year. Because of the amount of work and effort that we put into Easy Equities and other assets, I think we're going to have the headspace to think about GT a bit more. And really there, we have to think about what the future of that business is going to be inside the group. Does it fit well within our dreams and aspirations as a group? And if it does, then we must pay more attention and bring it closer to the group, the brand, the culture of the organization, because it is still held very separately from some of the other group companies. And if it isn't, then we have to think about exiting it. And I'm 50-50 on this. I said it at the end of last year. I don't know where I stand on it. I want to spend a lot of time thinking about it with my team and with the shareholders, and I want to be clear, coming out into the second half of the year, I want to be very clear about what we're going to be doing with Easy Equities, but we've got to put a lot of thought and effort into it. It's a business that deserves more attention, and either we're going to give it to that attention, or alternatively, we just think about exiting it out of the group. What am I leaving out? I'm leaving Ryze out. Ryze had a spectacular start. I mean, it's only 3 years old. I think it's just over 2 years old now, and it grew almost too fast for us. And then COVID hit, and it's one of those businesses that you can only grow in a physical world where you can, touch and meet people. And that's just because the way you sell in that environment is across the boardroom table, speaking to trustees. So it's using this downtime. So it's not scaling to meet client requirements. It's using this downtime just to really re-engineer some of the tech, which was, typical startup tech. You're always going to find not everything works as perfectly as it should. So a lot of time has been spent in the last 6 months and over the next 6 months re-engineering some of the tech, also scaling it, and then also implementing new features and functions. And in fact, one of the things that's going through now is it's playing catch up to the Easy Equities platform, because it's built on the same stack as Easy Equities. And as you know, we launched apps and lots of functionality last year, and Ryze got left behind. So we're using the time to bring Ryze back up to speed so that it's on par with Easy Equities functionality and mobile apps and user experience. So I think that pretty much summarizes where we'll be spending our time. That's where I guess we hope to be spending our time. If you think about last year, this time, if you'd asked me where I was spending my time and where I ended up spending my time, I wouldn't have got it right. So anything can intervene, but that's where I think we'll be spending the bulk of our time over the next 12 months.
Okay, so it seems like we're doing a lot of focusing and refocusing. But if resources weren't a problem, Charles, what would your dream new business? Because I mean, Purple is winning on the easy front, I think, on the asset management front, and so that covers like quite a bit. But now, what's your dream or what would you like for Purple Group to venture into, if at all?
Look, if end of last year I said no new businesses, because every year I find myself building a new business, and I'm still saying this year, no new businesses. Let's just focus on the rails that we've laid down for ourselves. We've done a lot of good work. We've railed down incredible partnerships, and all of the businesses that we've built in the last 5-6 years, all of the relationships that we forged, they all deserve our full attention. But having said that, the way we work is, 80% of our time we try to focus on the things that we think are going to be important this year, but then we always reserve 20% of our time for opportunities as they may present themselves. And so I can't say, there's nothing in my head today that we're going to build that's a brand new business other than our international business, where we are certainly going to build more capability and capacity. But I reserve, the right, I think that's my privilege as CEO, to pivot on that, because the one thing, as Easy Equities and the rest of the group continues to rise, the opportunities to partner new partners, to build new businesses, to partner our tech into new business opportunities keeps increasing. And it's very hard to say no when there's a very strong business case. So, the new things this year, if I had a magic wand, the new things this year: Kenya up and running, operational in partnership with a large bank; Australia flying 15,000, 20,000 customers a year from now, and highly profitable. And I would say one other region, either in emerging markets, and thinking there, places like India are interesting. I just don't think we're ready for it yet. We think a lot of customers, there's 300,000 active customers. India thinks that's a small brokerage. So, we've got to be ready technically for that. And I mean that, like a big brokerage in India has 12 million customers. That's proper scale. So I'm not sure we're ready for India just yet. I think it's more likely that we set up a European operation and focus, use the European licensing. So get licensed in one European country and then focus on targeting customers across Europe. I think that's an exciting opportunity. And the thing that what I want to avoid is competing with competitors that are bigger and have more balance sheet than us. We're still a small company, even in fintech terms. Our total market cap fluctuates between 800 million and a billion rand. But let's just put that back into dollars and get a sense of what that means. It's about $60 million. Robinhood was started. It was started with $40 million, and it's now a $10 billion fintech. So I don't want to go where they're going. I think we do things better than they do. I think our platform capability is better than theirs, but I'm not ready to test myself in that arena just yet. So I'd rather go to places where there are less competitors, that look more like South Africa, where we can win clients more easily. And when Robinhood looks up and says where they're going to go next, I want to be there. So that would be my wish. I don't want more capital. The business is highly profitable. I want to keep a good portion of those profits to build our balance sheet. So no expectations of dividends for those guys who are out there. I'm not going to pay you a dividend, not for a while. I want to use the balance of our profits to keep growing the group and diversifying our income streams globally, but also building new products and services. And in the new products and services space, we've got a few aces up our sleeve that we're not going to share, but we might surprise the market with one or two products. It's too early to say right now, but I'll reserve it. It's in my 20% rule.
Nice, love it. I really dig the sound of that. And so you mentioned the share price before we go back to Robinhood. You mentioned the share price. Now I know you don't care, not care, but you don't mind where the share price is right now. But a lot of investors would be looking at it and saying, well, Purple is winning on a bunch of fronts. Does the share price right now accurately represent the value of Purple Group? I mean, your opinion on that? Do you think it accurately?
Yeah, I mean, it's a great question, and I'm the deepest insider. I'm also probably the person who believes the most in our future. So the question, does it value Purple Group fairly? And the answer would be if somebody approached me now, would I sell all my shares? And the answer is no, I wouldn't. And that's a value decision, because if I thought we were at full value, then I would certainly sell all of my shares. So no, I don't think that the share price fairly values the group, but it's run hard, and your share price is a measure of your success, as disappointing as that can be. I think our share price movement came really late. I think that it should have been obvious to a lot more people a lot earlier that what we were building in this group was something special. And it's interesting how that can hold people back in terms of their mood and their attitude, because if you've got this external reference for your success, call it your share price, and it doesn't perform to the same level that you think it's going to, or it should, it can be quite negative on the group. Now, so I think the share price is playing catch up. I think people are starting to understand what we're doing, but frankly, and I'm not being disrespectful at all. There are shareholders, and I know that there's some on this call, probably many on this call, who understand this business really well. Shout out to guys like Junior Buffett, who he knows the business really well. But I don't think people understand the group very well. And so as they uncover and discover what we're doing, what we're about, and how we're doing it, and what our future strategies look like, and what that might mean for the revenue, then I think people will start to unpack Purple Group, and I think it will start to reflect in the share price, and I think it will start to appreciate faster. But for me, answer to your question, no, I don't think it values the share price. I'm not going to do an Elon Musk and say it's overvalued, and then his share price rockets like 1,000% on the back of that. But yeah, it's run hard. It's reflective of some of the success we've had. And I think the best way to describe it, it values the revenue that we've delivered. But I don't think it predicts or sets out our future. It doesn't predict our future value very well.
On point. Okay, so a big reason why the share price had rallied also was the Capitec deal. So now I want to know, Charles, do you one day want to see easy equities on every app? I mean, I would, but is that like a kind of, is that a long-term strategy? Is it a long-term strategy, or is it not at all part of the package?
Yeah, I want to. You take it further. I want to see it inside every school kid's curriculum. I want 12-year-old kids to be at school and to be introduced to easy equities and to learn investing and investments at that age. So I'm much more ambitious than just having it on every app. I want it in every single school curriculum. Investing is a life skill, and yet we spend lots of time trying to understand the anatomy of a locust, but we spend no time trying to develop this investing life skill. So every app, every textbook, every school curriculum is where I'd like to see easy equities. For now, our ambitions are restricted to everyone who's got a smartphone. And the good news on that is that that's changing fast. I think the cell phone penetration in South Africa has just breached like 40% smartphone penetration, 40% of the population. And if you go back 5 years, that was less than 20%. So, and the cost of smartphones is coming down and down and down. And India's got its first $10 smartphone in the market. So very soon, within the next 3 years, every single South African will have a smartphone in their hands. And when they do, the opportunity for us to reach every single South African is there. And the other force that I think is in our favor is, data costs are going to continue to come down. And at some point, someone's going to zero rate our data. I mean, the Capitec relationship you talked about, and let's talk about that for a bit. I mean, Capitec is zero rated, the data is zero rated. So when you trade or when you bank via Capitec, you don't pay any data fees, which means when you invest via Capitec, via the Easy Equities widget, you don't pay any data fees. And that's really cool. It means that somebody that is not spending their data on investing. And the Capitec relation came about because they believe in the same things that we believe in. They think that the future is lots of South Africans taking accountability, more accountability for their wealth, and doing it in a way that resembles the way we do it at Easy Equities. And they see us as a long-term partner and building that wealth business within the Capitec banking experience. And that's such an exciting prospect. I mean, 15 million customers, I think 6 million customers on their app. So we've got access to 6 million of them. And like-minded businesses with a very similar corporate culture, very entrepreneurial, very hands-on, not scared to try new things and to take on the incumbents. So, super excited about this partnership. I think for the next 12 months, it's a bit like dating. You've got to spend some time deciding whether this is the one you're going to marry. And I think Capitec, and we're dating Capitec's customers. We're not sure who they are, how they operate, what they think of us, what are the barriers we need to address for them to trust us. They trust Capitec, but do they trust us? And they don't know about us enough yet. So I think, for the next 12 months, we're going to be dating Capitec customers. But I think that beyond that, Capitec has got the rails for us to radically transform our business and grow the business at rates that we've never seen before. And it's not like we're growing our business slowly now, but we've got to win the customer trust in that channel. We can't expect that just because we're on the Capitec app and it says Easy Equities, therefore we're trusted and everyone should open an account. We've got lots of work to do there. More good news is that my favorite brand personality, sorry Standwa, it's Carly. She's on it. Sorry Lesedi, it's Carly. Sorry Bonolo, it's Carly. But Carly's on it. And, I couldn't think of a better person who would be responsible for ensuring that Capitec relationship, we move from dating to marriage soon.
Hundreds. And speaking of that, Carly's wedding is actually coming up soon, so shout out to you, girl. I want to speak about then, you mentioned how one day you want to see it on all the kids' apps, you know, in schools. That means you're very much like people-centric and you want the people to kind of, you know, have access to investing. So, well, okay, firstly, actually, let me start here. Is this where you envisioned Easy Equities going? Is this what you actually wanted for not only the brand, but for the actual landscape?
Yeah, I mean, it's, you know, the key thing about Easy Equities, which is different about every other business that I've built, is when we thought about Easy Equities, we said, you know, what's its purpose? And its purpose was to democratize share investing. And, you know, we didn't think about how much money we could make, how many customers we needed to make that money. What we thought about was, what's the difference? What's the legacy we want to leave? And the legacy that we wanted to leave as a team, as the founders of Easy Equities, was that we wanted to be recognized for democratizing share access. And, you know, it was from establishing that purpose that we went on to think about, well, how do we do this now? When, you know, for hundreds of years, people have not democratized access, and we identified the friction points and built strategies around those friction points. And, you know, lots of people have heard the stories around this. But, yeah, 100%, you know, we wanted right from the start. It was our vision. If we were going to democratize anything, then we needed everyone to have access. We wanted 10-year-old kids and 90-year-old goggles to be part of the storyline. And the beautiful thing about Easy Equities, and Standwa, you know this so well, you know, you've been around this business a long time now, is that they're 10-year-old kids and they're 90-year-old goggles, and there's everyone in between. And the fabric of our customer base is the fabric of South Africa. It is a truly South African business in every single way. You know, the team that's running it, the capital that's behind it, but then also the customers we serve are 100, because this is the demographic, this is the fabric of South Africa. So we were the seed that started this democratization. But, you know, as a business, we now stand on the backs of our customers. They are our biggest marketing currency. They are the educators of tomorrow. They're the ones who are driving this disruption. And that's the stuff that I'm so grateful for. Because I think, you know, a lot of the time people turn to us as the insiders, the founders and the team, to say, you know, congratulations to you, well done to you. Well, yeah, thanks, we appreciate it. But really, it's well done to our customers. It's well done to the shareholders that believed and gave us the capital to do this. Those are the people that deserve the credit, because, you know, 60% of people arriving today are thanks to customers bringing their friends and family. And 60% of the education that's happening is thanks to people that are bringing these customers. So, yeah, this is what we wanted to build, or we dreamt of building, but I don't think we believed strongly enough that when the tidal wave eventually came, that we'd be riding it quite with this kind of vigor and momentum.
So then, speaking of the tidal wave that are the people, tell me, what do you think of what's been happening in the States? I call it the Battle of Wall Street. I don't know, it probably is the mainstream name anyway. The hedge funds versus the people. What do you think? What do you make of everything that happened over there?
Yeah, look, firstly, it's fantastic. You know, I love it. And, you know, anyone who knows me knows that I'm a retail guy. So I'm not a big institutional fan, and the institutions don't like me much either, which is probably why the share price is still where it is. So, you know, I love, you know, our cause is the retail cause, and 100% I love what's going on in the US. But let me be fair to both sides of the argument. Firstly, Robinhood had no choice. You know, they're a competitor. I'd love to say they got it wrong, but they had no choice but to shut down the stocks. And to understand why, you have to understand that the ecosystem in the US is actually very different to the ecosystem in South Africa. So the custodians, the clearing settlement houses and the custodians rely on 2-day settlement, but they place a lot of trust into the system. And so they trust the brokers in a way that South Africa doesn't. So as an example, we have to report our retail client holdings at a shareholder level, and you even report it whether it's an equity holding or an OTC, a derivative holding, or a futures holding, CFD, etc. In the US, you don't. You sort of just, the custodian doesn't have sight of the customer, doesn't have sight what the customer's contract is. And so what happened is that these custodians, they saw all of this activity and volatility happening in GameStop and GameShop. And is it GameStop or Shop? I always forget.
Stop. So it's GameStop.
GameStop, yeah, GameStop. Looks like a game shop, but it's GameStop. So they saw all this volatility and obviously price action. And they were worried, obviously, about where the risk of not settling, money not being there, because the brokers have got 2 days to deliver the money. What happens if the money is not there? So what they did to prevent that happening is they raised the capital requirements by 250%. So for one share, let's say a GameStop share at $100, the broker had to put up $250 for one share, $100 share. Now customers aren't going to do that, and so what this caught the whole market by surprise. In the history of stock trading, I don't remember this ever happening. I'm sure it has, maybe in 2008, but it caught the whole market by surprise. That's most notably, it caught Robinhood by surprise. And in order to meet those obligations, they had to raise capital. And you saw they raised emergency capital. They raised $3.4 billion in like a couple of days. And now they've turned the taps back on now that they've raised the capital. But again, they'll be limited by how much capital they've got. So to be fair to Robinhood, they couldn't have seen this coming. People said they should have had more capital. They should have seen this coming. Nobody saw this coming. If anyone saw this coming, the short sellers would have been out, before. So it's been a fascinating case study. It is the future. That's not what I want to say. What I want to say, it represents some of the forces that are going to be prevalent in the future. And excitingly, the force in the future that is going to be the most powerful is going to be the retail investor. And I tweeted a week or two ago, I said CEOs are going to have to take their retail investors more seriously. They're going to have to think very seriously. And someone who does that really well is Elon. Elon's he's got his retail investors, at his thumb. But other CEOs of the future are going to be more like Elon. They're going to be more connected to their retail consumers. Where today, if you're CEO of a listed company, and this is where I'm not good, a CEO of a listed company would not do what I'm doing now. They wouldn't do it. They would spend this time talking to institutions, making sure the institutions understand. The future CEO is going to have to do this much more. And that's such an exciting future for us because, if you think about it, we are going to have that access to those customers, to those shareholders. We're going to, as retail investors, we're going to control the dialogue and set the course for the strategy of businesses. And I think it's such an exciting future. I hope it plays out sooner. But GameStop is just one example of those retail forces exercising their vote. And, in this case, Robinhood got in the middle of a fight between institutional shorters and, so the Reddit army. And in the result, the party that really got bruised was Robinhood. And sadly, a lot of retail investors, I think, have lost a lot of money. If you look at where the stock is now, the shorters, and no one's sad about that, the shorters have certainly lost a lot of money. But there's I think it's an African proverb, where two elephants fight, it's the ground underneath that gets trodden. And I think that's really what's happened here, is two elephants got into a fight, and really the damage has been the ground underneath.
And speaking of which, though, that actually trickled onto us as well. So if we can speak to what happened on, I think it was Tuesday, where we had Nokia, where we had to kind of, when we limited trading on Nokia. So
exactly the same thing. So, again, I've seen some Twitter criticism of us as a result of this, not too much, thankfully, but, we are not a stockbroker in the United States. So we rely on stockbrokers to access that market. Now, the stockbroker that we use is called Drive Wealth. They're what you call an API broker. So they enable a lot of the fintechs. Like I would reckon 80% of the fintechs that have access to stocks in America go through Drive Wealth. And their custodian increased the margin rate, so the custody on 4 shares. GameStop was one of them, but we didn't have it. Of the 4 shares, the only one that we had on our platform was Nokia, by 250%. And so we would have, for every $100 of that stock, we would have had to use our capital to put up another $250, so $350 in total. And we just can't do that. We're not that kind of business. We don't provide any margin or leverage or gearing, but they don't distinguish between that. So the custode Drive Wealth couldn't do that either, our broker. So Drive Wealth shut our lines onto those stocks, and they've gone to try and find alternative lines to see if they can reopen them. And as soon as those lines have been reopened, then we'll reopen those stocks. But we're just playing by the rules of the custodians. We don't have the power to set those rules. What we will do vociferously is voice our disappointment on behalf of all of our clients, which we've done. And Drive Wealth, I can say they're great partners. They really are. They're listening, and they're going to take action to see how we can prevent this happening again. I mean, this is how rules are changed. There are these kind of events, cataclysmic events, where the regulators and rule makers look at them and go, how do we prevent this from happening again? So I think for sure the SEC and the US and the US and other regulators and the custodians and clearinghouses and the broker dealers, everyone's going to be sitting down over the next 6 months to say, okay, guys, how do we avoid this? If the future of investing has more retail in it, then how do we avoid these events going forward? So, for those that leveled the criticism at us, we'll take it on the chin, but know that it had nothing to do with us. It has 100% to do with our broker dealer, and their very valid excuse, which we take, is because their custodian raised the margin collateral rates on those 4 stocks, and there's nothing they could do about that. You can't just change custodians.
No, hundreds. Understood. And I hope this actually illuminates it for our community. But actually, funny enough, we didn't have that many complaints. So I think we have a smart base who actually understood, who read the email and understood. So that's very dope. So
yeah, Charles, look, I think, Standwa, that's a good point, and one that our customers trust us a lot, it's magic. And I'm really grateful for their trust. And I want to say this is, we will always act in the best interests of our customers. You are our greatest asset, not the lines of code that hold up our platform. So you must know that we will always make the right fight for you. But there are some fights that we can't win. And when we don't win them, we will agitate for change that in the result creates a better environment for retail investors in the future.
100. Love it. So now I'm actually gonna hand over to Henno. He is he's our maverick man in the community. Love this guy. And he's gonna pretty much ask the questions that you guys have been giving or asking us on the Q&A section. Henno, over to you, man.
Great, thank you very much. Good day, Standwa. Good day, Charles. Thank you for everyone that's attending. Our first question is from Tsepu. Does Capitec own any shares in Purple Group?
Yeah, geez, good question. I don't know. I don't think so. I haven't looked at my share register recently. I'm sure they would have told me if they were taking a position. Capitec is one of the things I've learned about Capitec is they stick to what they're good at. And they're a very good retail bank, in my view, the best retail bank in this country. And so I very much doubt they'll be taking an equity position in something like us. I think they voted their confidence by partnering us, and that's as far as the relationship goes. But to my knowledge, Capitec doesn't own shares in Purple Group, but as I said, I haven't looked at my share register recently.
Great stuff. Then the next question is from Rafiwe. AMC in 2020 made more than 100% profit in the New York Stock Exchange. I don't know why it was never added on Easy Equities.
Yeah, this is another good question, and one I field a lot on social media. So and I did deal with it the last AGM, but it warrants repeating here. So let me how do we choose the stocks that come onto our US platform, and why don't we have the whole universe of US stocks? So the first point is our broker dealer that we deal with only services stocks in the US that have a market cap of over $2 billion. So those are the only stocks that we can get access to. So if it's under $2 billion, we can't get access to it. So that's the first thing. And that's their strategic choice to do that, not ours, but they are API broker. And finding an alternative API broker is not a simple thing. In fact, we haven't found another one who can give us the services that we want. So for now, that's a restriction. We can't get stocks under $2 billion. So that's the first one. The second one is that if for every stock that we add to our platform, it comes with an intrinsic cost. So there are data costs that come with it. We have to pay. There are the corporate actions feeds that tell us when dividends are coming out, the calendar on the dividends, the amounts. They give us the amounts. We've got to settle those amounts, and then obviously every share that we add to the platform adds resources. South Africa total 400 stocks. Add all of them, man. It's not a big deal. US 15,000 stocks. Don't add all of them. It adds a lot of resources. It will consume a lot of resources, capital, machine resources, etc. The other thing it'll do is it'll overwhelm customers with choice, which we don't want to do. So we took the decision to say, let's focus on the stocks that South Africans most understand. And our view was those would be the index stocks. And that's how we started. So S&P 100, NASDAQ 100, Dow 30. I think those are the 230 stocks we started with. And then we said, as customers arrive, as that business scales, tell us what stocks you want, and we'll add them once a month. And I think, last week we added 60 stocks across our platforms. And, the US platform is the fastest growing platform in the business. And so I expect that every month we're going to be adding 20 to 30 stocks. So over the course of the next few years, we will probably end up very close to that 15,000 stocks. But we wanted to do it in a responsible way that didn't create too much overhead for the group, both in terms of capital and in terms of system and resources. And the reason for that is that we wanted to keep costs low. So, we didn't want to build a system that could take 15,000 stocks and hope that customers came and charge customers expensive rates. So it's a balancing act for us. We've done the same in Australia. So Australia, we launched with about 300 or 400 Aussie stocks. There are over 1,000 Australian stocks. And as our customers grow and they want access to more stocks, we'll certainly add them. So yeah, that's the answer. And we do recognize, we take that the way you vote stocks onto the platform is not good enough. So good news is I saw a little tool that Tristan Finnemore and his team have been testing, where you'll be able to vote stocks up and vote them down. And then at the end of the month, you'll all be able to see which ones are being added based on the weight of customer votes.
Right, great. Here's another question that I've also seen pop up in the past. Can Easy Equities please consider having a two-way authentication applied to the app for extra security?
Yes, they can. Coming soon. So as I said, priority this year, stability, scalability, security. So in the security box, two-factor authentication. Code is a long way down the road. And I haven't got a date on it, and that's not because there isn't a date, just I'm not part of that project. So coming soon, two-factor authentication.
Charles, can I ask you a question that came from Lee Scott? And he's asking about GT. Why would you want to separate GT from the group?
Yeah, so how's it, Lee? Firstly, Lee's there can only be one Lee Scott, so it must be the Lee Scott who used to work with us. And he's, just full disclosure, Lee's been a long-suffering shareholder, not so suffering anymore. So welcome, Lee. And it's a good question. I mean, as I said, Lee, it's a 50-50 for me. But what's against GT staying in the group? And a couple of things. One is it's not a business that has grown in the last 10 years. So it's got quite a stable income stream, and it provides that stability has allowed us to build the group on its income stream, but it hasn't grown. And for those who understand that business well, your customers last about 13 months and then they get tired of trading, they move on. And so you've got to replace your customer base every 13 months. So it's a very hard business to grow as well. And there are others in the market, not in South Africa, but globally, that have invested more time and effort in those business models than we have and are growing their businesses. So, it's a business that we haven't been able to grow as a team. And as a result of that, I would rather take all of our focus and energy and focus on things that we are passionate about and have got a successful track record of growing, because it does still distract us. It's still a big component of the business. It's still something that consumes resources. And the back of my mind, I go, what if everyone inside Purple Group was focused on easy equities? We've had amazing success in the last 5 years, but what if everyone was working on easy and easy alone? What would that success be? And I'm not saying we must get rid of easy properties, and I'm not saying Ryze. I see those things as all easy equities, and I think Emperor has got a very strong role to play inside easy equities in the future as well. But GT doesn't fit naturally there. Traders and investors, the line is blurred. Robinhood is blurring those lines a lot. So for me, I'm giving you the one side of the argument that says we should focus 100% of our resources on easy. There are lots of reasons why we should keep GT as well. But your question wasn't about keeping it. It was, why would you want to get rid of it? So those are some of the things we're considering. And I want to be clear. We haven't made the decision to exit it. I am 50-50 on it. If I was firm in it, I promise you, I would tell you. I'm not trying to avoid making the decision, but we have to get firm in it this year. So, strategically, I've made the point to my board and to my team that we will set the course for GT's future this year and be open and transparent with our shareholders and customers.
Do you expect easy equities running costs to keep growing at 50% per annum as you develop new products, or will they start stabilizing? At what level do we expect annual cost to find a base?
Yeah, a really good question, and one that I'm going to give you a much better measure to keep watching. So don't watch the cost line, watch the cost per customer line, and that's the key. So what is it? Because obviously, if we're scaling a business and we're getting more customers, there are going to be more costs associated with those customers. There are costs that have to go up when you've got more customers. So let's just use an obvious one, like hosting. More customers, you need more capability on your machines. Therefore, you need more hosting power, which means you need more money. So the real measure to keep track on is what is our cost per customer. And what we do there, or what Gary does, the CFO, is he looks at the expenditure and divides it into the number of customers. And I think he highlights it in our AGM. If he didn't do our financials, then I'll highlight it here. But that cost came down 44% last year. So whilst our customer revenue went up. So what you've got is a perfect kind of scenario where your customer revenue every year is going up and your cost per customer is going down. And so we're getting what I would say is we're getting leverage over our cost base. It looks like costs are going up far too fast, but you have to take them in context of the customer numbers. So, and that isn't an excuse to say that there aren't costs that we're looking at. I mean, when you grow fast like we have, and unexpectedly like we have, there was unexpected growth in COVID, then you sort of buy in services to patch holes, and you don't necessarily spend too much time negotiating the best price. So there are a couple of things we've identified where we can optimize those costs, and they're significant. They'll save us a couple of million rand if we get it right, which is cool. But fundamentally, the real measure that you need to watch if you're tracking us as a shareholder is what's our cost per customer doing. And if that's going down and revenue's going up, then pop the champagne and buy more shares.
Thank you, Henno. So guys, that's the end of it, I believe. Charles, any last insights from you?
No, I just want to say thanks. If you guys want to do this more often, shareholders, clients, customers, then, I'm up for it. So, just have to ask. And if you want to ask the right person, ask Standwa, because he'll make it happen. And yeah, I really enjoy chatting to all of you and dealing with your questions and or concerns. We learn a lot from your concerns, and we're listening, and we are constantly looking to improve our platform and services, and we're appreciative of your support massively. We're not perfect. Things go down. You'll know that as a customer of ours, but our commitment is that no harm will be done when they go down, and that we are spending an inordinate amount of time and focus on making sure that it gets better and better all the time. And together, as customers, shareholders, and staff, we're building something really special here. Something I think that people will reflect on in 30 years and say, how did that happen? And you're going to get to say you were a part of it. And that's very, very cool. And yeah, thanks for attending. Thanks for coming and listening. I hope you enjoyed it.
All right. And that was Charles Savage, guys. Thanks to everyone who attended. Big shout out to Henno for coming through. Thanks to CNN Co for organizing. And big thanks to Charles, man. What a legend. Can't wait for those chats. So,
okay. Cheers, guys.
Till next time, guys.
Great. Thank you, everyone, for having me. It was a pleasure.